James Sullivan, head of Asia Pacific Equity Research with JP Morgan, joins us now. James, good morning. Thank you for joining us. James, the world is feeling very, very, very different. James, my question is, the world is feeling very different. It is risk on, no longer, it is risk off, no longer risk on. Everybody is worried about inflation and equity as an asset class. It reminds me of a phrase I used to use in a bear market, that equity as an asset class has gone to butcher blocks.
I think you're right that the transitional nature of markets is a critical aspect of the conversation. And any time that we go through a period of regime change, it creates significant volatility. And that's very clearly what we're seeing in markets. What I would suggest is we're going through several areas of regime change. First, from a monetary policy perspective, as you very rightly highlight, the views on inflation and monetary policy tightening that we're seeing in major economies like the US, but also somewhat surprisingly now, even with the RBI action recently in India, indicates a very different environment for macroeconomic policy. We're also seeing a significant inflection in the nature of economic growth with significant slowdowns in markets like China here in Asia. And then lastly, in terms of the structure of global trade, we've had very clear comments from people such as Treasury Secretary Yellen, EU President Christine Lagarde, who are indicating that the Washington consensus around free trade is effectively over, and we're moving from an era of globalization to one of regionalization. So we have these massive cross currents across a range of issues right now, which are triggering the volatility that we're seeing in markets.
James, so what is the right way of looking at this transition? How much of this transition is something which is already priced in? The fact that you and me are discussing inflation, markets, I'm sure would have priced that in way ahead of its time.
It's a great question, and one of the aspects of markets that I've always enjoyed is the issue. It's not just a game of forecasting reality. It's a game of forecasting reality versus expectations, and the expectations that you're highlighting are of critical importance. The inflation conversation is an interesting one. We're currently looking at long rates in the US as an example above 3% for the first time in a very long time. That said, however, if I look at traditional Taylor rule macroeconomic analysis, that would indicate that US rates need to peak somewhere above 4.5%, which is very clearly not in anyone's forecast, but also not in market prices yet. Similar conversations regarding different underlying sectors. You were talking in the opening segment about energy prices and the potential for changes in the price of oil to drive different outcomes for the market. At JP Morgan, we've run a piece of analysis that shows a 20% gap between global supply and demand within the energy complex. On our estimates, that will take over 1.7 trillion US dollars to close that supply demand gap. And we see as a result, we see very strong upward pricing pressure on oil specifically for an extended period of time. So if I take a step back, the short answer to your question is I think investors really need to take a very bottoms up look at individual countries and sectors at this stage, rather than an overall asset allocation to equities as an asset class.
Good morning. So when you talk about this kind of a strategy for allocation, the fact is India is still outperforming the rest of the emerging markets, even though we have seen foreign investors start to sell, and they are selling far and fast. What do you make of that? And therefore, does India still demand a premium, and is it going to continue to command that premium?
So two incremental questions there. One, the outlook for India outperformance relative to the rest of the region. Two, a conversation regarding valuations in India today. From an outperformance perspective, you're absolutely correct. India has outperformed. Within an Asia context, we've really seen the ASEAN markets as critical drivers of the regional conversation, with markets like Indonesia, Singapore, where I'm based, Thailand, and even the Philippines up until recently, showing very strong market performance off of the reopening trade that we've seen in those markets. India has been an interesting conversation where we have seen a slowdown in economic growth. We have seen rising oil take its toll on current account conversations for the broader macroeconomic outlook for India. Again, the JP Morgan house view is that energy will remain well bid for an extended period of time. And we've seen some compression in the margin cycle in India. It's really been a valuation conversation, which drives the second leg of your question. What's interesting to me is economic and financial theory would argue that now that the RBI is starting to step up rates, that should be multiple compressive within an Indian context. What our analysis has shown that actually hasn't been the case historically. Indian multiples have traded far more off of global equity indices rather than local rates. There is still the potential for downside pressure there because you obviously have significant multiple compression occurring in global markets, inclusive of the US. And so at JP Morgan, we're taking a relatively cautious outlook for India as a whole. However, within that, again, this bottoms-up analysis is absolutely critical. We still see emerging strength as an example in the rural consumer.
James, somebody's trying to reach you frantically. You want to take the call? I can stay connected. I mean, if my wife's call, I have to take the call, James. Does that work for you as well?
I'm fine. Please, let's continue.
So are you saying that your wife's call, you didn't take the call?
No, it is not my wife, actually.
All right, so then we can move on.
Who it actually was.
James, if I look at a large investable market, I guess India has got everything going for itself. We are on a economic curve. We have a strong positioning in terms of political stability and also the way the capex cycle has started. At what point in time these factors become a unique advantage factors for India?
It's a great question. And one of the things that I've been most interested to watch over the course of the past 5+ years now are the changing policy dynamics that are at play within the administration of the Indian economy. You've seen very significant levels of experimentation coming out of the current administration. You still have very clear policy changes that, in my opinion, can be made to drive incremental economic growth in India. And one of the reasons why we're seeing the valuation premiums that we're seeing in India relative to the rest of the region, as we see major economies like China start to see significant slowdown, which is likely to continue going on into the future, which we can discuss in greater depth, you still see India at very significant and high levels of economic growth. The premium that investors are willing to pay for that moving forward is likely to increase because of the scarcity value of that economic growth.
James, a lot of institutional investors are also of the view that, look, India is a great story, but China is attractive. And there is where the underperformance is. So there is more bang for the buck, so to speak, if you invest in China because you have the valuation comfort. What are your thoughts on that?
It is an interesting argument. And ultimately, the question in China right now is, what am I pricing in? Am I pricing in a return to historic normalcy? Or am I looking at a different regime and a different conversation moving forward? What's interesting to me in China right now is the fact that for the first time since China published a GDP growth forecast in 1999, we had very public disagreement from private sector forecasters relative to that government provided forecast. So the Chinese government right now is at 5.5% GDP growth for this year. JP Morgan's at 4.6%. If I look broadly speaking, there's 72 banks that forecast China GDP. 70 of them are below 5.5%. So it's the first time we've had this type of public disagreement. What's very clear from the commentary, in my view, coming out of the Chinese government is that they are changing focus from growth at all costs to this concept of common prosperity and more inclusive growth moving forward. That is likely to result in lower absolute levels of economic growth. And so I do think we have to price in a different future and not this return to historic past, in which case looking at historic trading ranges is less relevant than it might look at first glance.
And in fact, China seems to be an outlier when it comes to inflation. While consumer inflation is up, the factory gate inflation, the data that just came out, at least published by the government, seems to indicate that that has eased off. But James, I'm going to just put it as crudely as I can. If foreign investors right now are not investing so much in China, if they're not investing in Russia, and they're not going to, shouldn't India just become, also because of elimination, a hot destination as it is?
I think to some degree you were seeing that for most of last year. Obviously, with the FII selling year to date, that's been less of a story this year. My impression is that ASEAN has been a key beneficiary of that. However, I do think we have to take the step back and recognize that investors have a choice. They don't necessarily have to be in EM. And in actual fact, that's what we've seen. So we've seen EM as a percent of global asset allocation go from 13% to 9% to currently 6%. A lot of that drawdown, as you highlight, has come out of China, but we have seen overall asset allocation to EM fall. And one of the things that I do think we have to be cognizant of is the environment for the consumer in different countries around the world. In Asia, the consumer has taken a hit, and we've seen falling consumption trends in many of the Asian economies. In markets like the US, however, the underlying microeconomics look very different. JP Morgan estimates that we have about 13% of GDP in excess savings sitting in the bank accounts of the US consumer. Now, they're not particularly confident, and you're seeing consumer confidence surveys at their lowest since the 80s and in some cases the 70s. So that confidence will be required to unlock those bank accounts, but you do have significant propensity to spend. And so it's an open question where incremental asset allocation goes to DM with this very strong consumption story and this excess savings story, or to emerging markets. So far, we've seen a significant drawdown in emerging market allocation.
I wanted to also talk about the outlook when it comes to individual sectors, and I believe some pockets within energy and industrials as well is a space that you look at closely and that you are bullish on. Could you just walk us through the overall thesis at a time when we're also seeing spikes of volatility within crude oil prices?
So my first comment would be, I think we have to get used to current levels of volatility. As we started off the conversation, we're seeing several different elements of regime change all occur at the same time, all of which drive volatility spikes in multiple asset classes. And that's exactly what we're seeing right now. And I don't think that will go away in the short term. From a sector perspective, particularly within an Indian context, we've already talked about the energy complex, where we have this 20% supply-demand gap, $1.7 trillion in incremental capex to close that. That will take a significant amount of time. And so we see a very well-bid energy complex over the course of the next couple of years. The incremental question there is, do you see a complete shutdown of Russian exports, particularly of oil? JP Morgan forecast has that taking oil prices to 185. That's not our base case, to be clear, but that's the analysis that we've run on that potentiality. But still a very well-bid energy sector moving forward. A sector that we're spending increasing amounts of time on is actually agriculture, both regionally as well as in India. The incremental storyline regarding food insecurity, I think, has to be one that becomes front and center in the debate going forward. The FAO estimates that 275 million people globally will experience extreme food insecurity over the course of the next 12 months. We've seen very significant increases in the price of many agricultural goods, as well as the cost of production that feed into those agricultural goods. At JP Morgan, we've run some very detailed analysis to try to better understand the revenue implications of that for the Indian rural consumer. On our analysis, we have their overall income going up by over 13% on a year-to-date basis. And so we actually see a significant turnaround in the rural demand and the rural consumption story, particularly in India.
What about the entire financial services sector as well? Because that's a space that you'll look at closely. You spoke of, what you're expecting in terms of the Reserve Bank, that the hikes will overall compress valuations in the Indian context. But how would you look at the financial services space in light of this?
No, it's a great question. We are overweight financial services in India. One of the arguments there is the fact that the overall credit cycle will be more benign than is currently forecast. Also, the rate increase that we just saw from the RBI that you just highlighted is theoretically conducive to higher margins and higher net interest margins within financial services companies, both in India as well as globally. The fact that financial services have been underperforming in India, particularly relative to the high valuations that we're seeing for the index as a whole, creates a very strong situation for outperformance moving forward. So we do remain overweight Indian financials.
James, they say in the market that history may not repeat itself, and it certainly rhymes, and it ends up becoming the biggest indicator for us to understand. So if you have to draw a parallel in last 10 years, 15 years, when did we see similar circumstances?
It's hard to see parallels within the last 10 to 15 years, particularly from an inflation expectation and reality perspective. You really have to go back to the 1970s. It's interesting to me that when we run analysis on current levels of wage growth in the United States and other countries around the world, we don't see this level of wage increase really at any time after the 1984. And so the analogies that we're going back to really go back to the 70s and 80s. Again, we talked at the top of the segment on this regime change conversation. I think one of the things that we have to do is to take the step back and realize that the most significant regime change that we're discussing right now globally is a shift in returns from capital to labor. We're seeing that in terms of interest rates. We're seeing that in terms of rising wages in multiple countries around the world. We've had this 25 years experience where the overall return structure has gone from labor to capital that is now starting to reverse out. And that's critical in terms of our global view.
So James, what is in store for an investor? There are phases in the market. If you do growth investing, it does well. There are phases in the market. If you do value stroke dividend yield investing, that works. What kind of investing style we are in for next 3 to 5 years?
So the JP Morgan House view is that value will outperform as a factor of investing, particularly here in Asia over the course of the next couple of years. That's predicated upon a rising rate cycle, and again, this shift in the overall return structure from capital back to labor, and that's our expectation at this stage. The one interesting thing about markets right now is that we are seeing very high levels of correlation across both factors as well as asset classes. And so you get the type of environment that we've seen over the course of the past couple of weeks, where it's risk on everything or risk off everything. That creates very significant issues for asset managers because you start to lose the diversification benefits of a cross-asset portfolio. But we do think that's going to be the reality of where we are as we work through these various elements of regime change.
James, at what point in time you would say that, look, central bankers, first they were slow in tightening, now they have over-tightened. Everybody is now worried about inflation. The US president is now really openly commenting or giving his views on inflation. What I'm trying to understand from you is that what are the chances that what is concerned right now, which is inflation, may not be the concern because of over-tightening by central bankers?
It's a great question. There's two components to my answer. One would be inflation expectations moving forward. We've seen a lot of debate regarding supply chain disruption as a driver of the current inflationary conversation, and that's absolutely correct. The bullish view on inflation is that as supply chains begin to sort themselves out, then we've already seen peak inflation. The counter to that, as we've already discussed, is that you are seeing significant upward structural pressure, I would argue, in both energy as well as agriculture, that will continue to at least keep inflation roughly at current levels for a reasonable period of time, potentially slightly lower than where we are right now, but will not present an opportunity for a full reversal. And so that the changing structural nature of the drivers of inflation is an important part of the conversation. And then the second part is expectations versus reality, as we discussed previously. The reality is at the moment that US rates are actually very stimulative because you have inflation running at significant premiums to rates, which is a fancy way of saying you have negative real interest rates in the United States right now. Again, that is stimulative in nature. And so you put the two conversations together, and it's a bit of a moving target in terms of where inflation goes. But we have to take a step back and recognize that most rates as currently set by central banks around the world are still relatively stimulative. That's a problem given the inflationary environment that we're currently occupying.
James, appreciate your time. Thanks much for joining in and sharing with us your outlook on the global markets and where India stands in that context.